Well, it's much worse than I had thought. You can't believe the price to earnings ratios. I'm stunned by this. Stunned. I had no clue. So let's start the day with this article from from Mark Hulbert. And I've been reading Mark for a long, long time. This is on Market Watch, which is I guess a subsidiary of Dow Jones. This is a simple reason you can't believe the PE ratio for the S&P or the Russell 2000 right now. Dateline July 6th. So let's read this. If you want the real PE for an index, PE's price to earnings ratio, that is the valuation. How many dollars you're paying price per $1 of earnings. So you take the price of the earnings. Well, you divide the earnings by the price, or the price divided by earnings. I think you divide the price divided by the earnings. That will give you your PE ratio. Historically, a PE ratio of about 15.5 is for the S&P 500. Probably a little bit higher than that for the Russell 2000 because of small caps. But that's very misleading, and for a number of reasons. First and foremost, the PE ratio, the price is current, the earnings are hindsight, if that makes sense. So in a lot of ways, that could, and right now where we're going through a PE ratio based on previous earnings, even still back in Q1, or even Q4 of 2019, which are no way reflective of the current coronavirus situation, but yet the price is based on today. All right, so it's a hindsight number for the earnings, and it's a current number for the price. It's tough to make any hay of that. But then this gets worse. I had no clue. So if you want the PE ratio, the real PE ratio for an index, you need to include those companies that are losing money. All right. Which of the following Russell 2000's PE ratios when calculated are based on trailing 12 months? Again, that's the thing, the trailing 12 months. So I want to stress this again. I know this might be overkill, but in March 23rd, the market was at the lowest. And I can't remember the top of my head let's look at the S&P was, just to give an example. On March 23rd was a market low. Oops, hold on a sec. So we'll go to S&P 500. And right there. So the S&P 500 was down to basically 2,200. All right, so that was on March 23rd. Q1 earnings hadn't come out yet. All right, so it's still using the E from the price to earnings metrics based on earnings in 2019. 2019, the earnings weren't great, that's for sure, but they were positive. That's a fact. However, Q1 and then Q2, the earnings were going to be horrifically bad. But the price on March 23rd was down 35% for the S&P 500, and yet the earnings were still based on 2019 numbers. So if you start here, even Steven, at the beginning of 2020, the prices fall 35%, and yet the earnings are still flat because the earnings were based on the previous trailing 12 months. That has no way, so it looks like the price to earnings ratio is low, with us it's a cheap market. Well, that doesn't mean anything if you're looking forward, because we have no clue what the earnings are going to be going forward, and we can actually make a guess is that the earnings are going to be the PE ratio will be quite high, because a lot of these companies aren't going to make money because of shutdowns and stuff like that. But yet, if you just looked at PE ratio on March 23rd, 2020, you say, whoa, the market is cheap, man. The market is trading at a PE ratio of 8. Well, it gets worse. All right, so it's the PE ratio of the Russell 2000 small cap, 17.5, 14.1 are meaningless. I bet hardly any of you answered C. After all, the benchmark is down 15% year-to-date performance, and you would be excused then thinking small and mid-cap sectors, this index, are closer to being undervalued. But C is the right answer. If you answer wrong, you're in good company. The two incorrect PE ratios in my quiz come from very reputable sources. 17.5 comes from Morningstar, and 14.1 is what iShares is reporting for that same ETF. Both numbers are significantly below the index's long-term average for the PE ratio. So not only what I'm saying is right, but then what Mark has said. So let's read on. The reason these two firms report such low PE ratios, which as a value investor, you're like, yay, valuations are back, is that their calculation excludes firms that are losing money. In many years, this exclusion has had little impact, but not now, since a significant percentage of small and mid-cap firms that are in the Russell 2000 are losing money. By excluding these firms, the calculations artificially make the small and mid-cap sector appear significantly undervalued. This is survivorship bias all over. Survivorship bias is, it's simple. You take 10 funds and you get the average rate of return of those 10 funds. All right. Now, if 2 of those funds go bankrupt, all right, you take the 10 funds, you do the average rate of the returns of those 10 funds to include the 2 go bankrupt. That would be, you think, what the mutual fund as that whole would give you of an average rate of return of the 10 funds. That's not how it works. They exclude the 2 funds that went bankrupt. So only the 8 funds that survived are included in the returns. The survivorship bias says we're going to completely pretend like those 2 funds, which people had hard-earned money in and went kaput, don't exist. It's crazy. I don't even know how that's allowed. Actually, I read an article a while ago. I'll never be able to find it. I didn't know this either. Mutual fund companies, hedge funds and whatnot, probably more hedge funds, they'll bring a pre-publicly traded. They'll bring an investment idea to fruition, pre-publicly traded. They'll fund it with their own money or whatever they call Series A investors. I don't even know how that works. But before it's marketable, before they have to actually issue a prospectus, I can't remember all the terminology they used to use, the tombstone notes or data, or the tombstone indications, whatnot. Before they have to issue all that, they'll bring this thing to pre-market. They'll raise money for it, though. And they'll take, we'll just say 5 investment ideas, 5 trading strategies. 4 go kaput, they lose the money and it goes away, no one knows about it. The last one remaining, they'll market that with the previous, before it goes market, record under basically saying this is what the fund did before we traded it publicly, and they'll use that as their performance measures, if that makes sense. It's insanity. So that's the old Baltimore stockbroker method. I'm telling you, I did a video on the Baltimore stockbroker. Maybe I'll see if I can't find it. It's insane. And so basically this hedge fund will say, look, we did 5. They'll say, they know we're going to put 5 funds out there, 4 are going to go kaput, 1 will be successful. We'll market the hell out of that one successful as if that has any freaking legitimacy to it. So that's survivorship to the umpth degree. And then they'll take that to the SEC. They'll run the various prospectuses. And they'll say, based on our on real numbers, this fund did 25% a year, without you knowing that there's 4 others that did nothing. It's the Baltimore stockbroker. Actually, let me see if we can't find something on that. Hold on just a second. All right, let's see if I can't find something on the Baltimore stockbroker, because you got to understand what this is. Hold on. I do have the Baltimore stockbroker one, which I'll put a link to the show notes. I did it back in January. So let's see what, all right, so anyway, let's keep going here. So let's go back to this guy here. So watch the video on the Baltimore stockbroker. I'll put a link in the show notes. All right, so what percentage of small and mid-cap stocks are reporting losses? I was unable to get data from the companies in the Russell 2000, but Vincent Delarue, a global macro strategist at an investment firm, told me in an email it's more than 50% are reporting losses in the S&P or the Russell 2000 in the mid-cap. I could get the necessary data for the small cap index from the S&P 5 of S&P and the S&P mid-cap index as well, but not the Russell. The accompanying chart shows what I found. Nearly a third of small cap stocks lost money over the last 12 months, and a fifth of mid cap stocks. That's crazy. And 10% of the companies of the S&P 500 lost money, which are not included in the PE ratios. In the large cap sector, the prevalence of unprofitable companies is lower, but still not insignificant. That's 50 companies in the S&P 500 have no earnings. That's not including the PE ratios. I did not know that. That's insane. Look at that. And 32% of the S&P small cap index has lost money. One guy says the Russell 2000, over 50% of small caps have lost money. And here's mid caps, about 20%. The reason that the Russell 2000's trailing PE is meaningless is that the companies in the benchmark collectively lost money over the 12 months. As this guy put it, the real PE is meaningless with a negative denominator. Don't try to wiggle out from underneath this conclusion by shifting your focus from estimated earnings over the next 12 months. Could not agree more. Estimated earnings we got TTM trailing 12 months, which is definitive. Then we got forward-looking earnings. This is what analysts predict will be based on analyst calls and company data and whatnot, as if that can't be manipulated. However, this guy says the Russell 2000's forward PE ratio currently stands at 132. Wow. For the record, let me stress that neither Morningstar nor iShares hides the fact that their PE calculations exclude unprofitable companies. But a casual visitor to the website might otherwise miss their footsteps that explain the methodologies. Footnotes, excuse me. Regardless, though, the investment implication is clear. The small and mid-cap sectors of the market that the Russell 2000 represents are overvalued in PE, and significantly so. This doesn't mean that these sectors or the market as a whole couldn't keep going up, but if you want to argue they will continue rallying, you need to base your arguments on something other than PE ratios. Let's just take a look. That's freaking insane. Go to Vanguard. I just want to see what... all right, so let's... investing. Here we go. Oops. So let's just look at ETFs. We're going to look at small cap. Right there, browse a list. All right, so let's do this Vanguard. I mean, that's... look, would I change my investments? No, I'm just freaking stunned by this. By asset class, we got treasuries. All right, so let's go down to mid cap. We got small cap right there. There's expense ratio. Okay, so let's look at the Russell 2000 ETF. Let's see if it shows us what the PE is. Price yield. Let's see what we got. We got a PE ratio on here someplace. That's a 30-day yield, market price. Maybe it's going to be here. Portfolio management. Yeah, right here, 16.4. Oh, there it goes. That's crazy. So let's just take a look here what they're saying. Report, but they don't say if they're including negative earnings companies. Let's see if it has anything in small print. Dude, that's crazy. All right, so let's keep going. I want to see what the VBK is because that's what I still own, VBK. There we go. Go down to VBK. Right there. So that's good. None of these companies are probably making money. I mean, the vast majority probably not. So it's under portfolio management, by the way. PE ratio here is 28.9. All right, let's go down to, that's crazy. Let's look at VTV. I wonder how many freaking companies in VTV. That's my biggest holding by far right here. I'm not going to do anything differently. And what are you going to do, man? That's the issue. There's nothing to do. Oh, we got to go large cap. VTV is right. Did I miss it? That's right here. VTV. And we'll go down to... So at least we know the dividend is a 3, as of June 30th, 2020 is 3%. PE ratio on this guy, 16. How would the PE ratio on the value large cap be smaller or higher than the PE ratio on the Russell 2000? That makes no flipping sense. Especially when that doesn't make sense. All right, so let's just, that's insane. Let's go price and performance on VTV. All right, so the last, let's see here. We'll say the last, here we go. It's averaged 11.23 in VTV. Let me just write this down so I won't forget. Over 10 years, but we'll just say 10 and 5 years is averaged 6.455. All right, so let's see what let's see what the small cap index is doing over 5 and 10. Oh man, it just, thankfully the SEC is there to protect us. If you're relying on the freaking regulators, man, I got a small cap right there. I got some oceanfront property in Arizona. By my back porch, you can see the sea. I got some oceanfront property in Arizona. If you buy that, I'll throw the Golden Gate in for free. That's some serious singing right there. All right, so let's see the performance of the Russell 2000 over 5 years is 4.32. So how under God's green earth is the freaking PE ratio of VTV higher than that of freaking it makes no sense, man. Of the Russell 2000. All right, there you go. So buyer beware. I don't even know how to title this video because I want people to see it. But hey, Growly McGee, I'll put a link in the show notes. Watch my video on the Baltimore stock market, the Baltimore stockbroker. That's this. All right, we'll see you guys.